I've heard plenty of people say that investing in the stock market is kind of a lose-lose situation because the system is inherently rigged in Wall Street's favor. I think there's some truth to that. It's incredibly difficult for a single retail investor to perform the same quality analysis as an institutional investor on Wall Street, especially when Wall Street has faster access to critical information and the ability to leverage some pretty powerful trading tools. Checking analyst ratings on Yahoo Finance to decide if your favorite penny stock is a buy is not the same as an institution paying some Ivy League quant $180,000 a year to track Elon Musk's every move and provide hourly updates on how his actions impact Tesla's earning projections. But yeah, it can definitely feel impossible for everyday investors to get ahead. However, the popularization of passive investment has been seen as shifting the tides in favor of the retail investor. Instead of battling against professionals, passive investors can often successfully match the market through index mutual funds and ETFs, yielding returns that beat out many on Wall Street. Passive investing offers a simpler approach, significantly lower costs, and a sense of security, which is especially appealing for those planning for retirement. For decades now, passive investing has worked exceptionally well. It's democratized investing, giving millions an easy and affordable path to the financial markets. Investors have poured trillions into broad market index funds, trusting that the diversification provided from this choice would mitigate a lot of the unsystematic risks and provide steady growth over time. But underneath all of this, I suspect that there's a critical yet kind of unnoticed flaw. A lot of investors aren't aware that the S&P 500, the backbone of many retirement portfolios, has become extremely concentrated. The Magnificent Seven now account for nearly 30% of the index's total market value. So I want to talk about how this unprecedented level of concentration actually exposes investors to a hidden vulnerability. Now, these 7 companies, Apple, Microsoft, Alphabet, Amazon, Nvidia, Tesla, and Meta, they dominate the landscape. Imagine your retirement fund meant to represent the entire stock market. It's essentially betting a third of its total value on the performance of a handful of tech giants. And I would argue that this concentration sort of cancels out a portion of the diversification benefits that are supposed to exist when investing in a broad market index. Historically, the collection of the largest companies in the S&P 500 have accounted for a much smaller portion, typically about 10 to 15%. But what makes this situation worse is that this concentration is exacerbated by the mechanics of how an index fund determines its weighting. Because indices like the S&P 500 are market capitalization weighted, as passive investing grows, more money automatically flows into the largest, best performing companies. This momentum creates a cycle where already large companies attract even more investments, further inflating their market capitalization and thus their weighting within the index. So rather than true diversification, investors might unknowingly be reinforcing this unintended momentum effect and amplifying their own potential volatility in the market. But this is actually not the first time we've seen something like this, which is why I want to talk about Nortel Networks in Canada. During the late 1990s and early 2000s, Nortel became huge on the Toronto Stock Exchange, at its peak making up over 35% of the TSE 300. Think of that as Canada's S&P 500. Investors assumed that this broad market exposure to the TSE 300 meant broad market safety, and everybody was really excited and proud of Canada's telecommunications giant. But when Nortel collapsed amidst accounting scandals and financial mismanagement, the fallout was absolutely devastating. Thousands of Canadians saw their retirement savings evaporate overnight. And I think this scenario vividly demonstrates the danger of concentration risk, when supposed diversification is actually masking significant exposure to a single company risk. Take Nvidia, for example, here in the United States. In recent years, Nvidia became synonymous with innovation in artificial intelligence and technology. It's kind of the pride of the United States. And because of that, it's experienced truly explosive stock growth with a company valuation of nearly 3 trillion USD. As its valuation has soared, this has significantly boosted share within the market indices. But what happens if Nvidia misses earning projections, faces some kind of regulatory scrutiny, or encounters some kind of challenge affecting semiconductor production? In the scenario like this, the damage to the overall market could be substantial. And when one heavily weighted company falters, the ripple effects to the index funds could result in far greater losses than many passive investors would have anticipated or would be able to stomach. And a decline in a major player like Nvidia can really undermine the stability passive investing seeks to achieve. Passive investment funds exist to provide diversification, but mathematically this becomes skewed when a few stocks dominate. Here's a simple example. If a company represents just 1% of the index, A dramatic 50% drop in its value would minimally impact the broader portfolio. But if the company accounts for 7% or more, say like Apple or Microsoft or Nvidia, a similar 50% decline could result in a measurable 3.5% loss to the entire fund. And when you consider multiple companies with similar weights, the potential losses add up pretty quickly. Adding to this risk, large technology companies frequently experience correlated movements because they're in the same sector. Diversification within that sector may eliminate some business risk, but it doesn't do much to protect you during an event that impacts all companies in that sector, which can cause some cascading effects. Panic selling among institutional investors exacerbates that decline, amplifying volatility and negatively affecting indices that are heavily weighted in technology sectors. We saw something similar here in the United States during the dot-com bubble burst in the early 2000s. Investors heavily weighted toward technology companies experienced a catastrophic loss when the Nasdaq plummeted nearly 75%. Millions saw their retirement accounts decimated overnight because their diversified investments were, in reality, dangerously concentrated. So how can you protect your investments from similar outcomes today? Well, I think it just starts with awareness. Understand what you truly own within these passive investments and assess whether this strategy aligns with your risk tolerance. Passive investing can be valuable, but its relative safety depends on genuine diversification, not hidden concentration of risk. Keep in mind, there's little you can do to diversify away market risk, but steps can be taken to reduce some of the masked, unsystematic risk that we're exposed to today. As always, I encourage you to consult a trusted investment professional before making any changes to your financial plan, but this is something many people simply aren't aware of. While I hope things work out in favor of retail investors, this is an important conversation to have because I truly believe the opposite outcome could be devastating for so many people. By taking a closer look at your investments, considering other diversification options or a more active investment strategy under the guidance of a financial professional, and ensuring that your risk exposure matches your goals, you can navigate any phase of the business cycle with confidence. But the keys are knowledge, awareness, and then action. So what do you think about all this? Please feel free to comment below. I'd love to hear your thoughts. I'd love to hear from you. Also, like and subscribe if you enjoyed the video and you want to see more. But until next time, have a good one.